Hi, this is Mary Rafa and welcome back. So on this section, we will discuss about personal residence. So remember, we are discussing about real estate property, and real estate is classified as capital asset. And now let's say, since you now know how to calculate the adjusted basis of your capital asset for real estate, and if you need a recap, just go back to the prior section to know what are the items that you need to include to get that adjusted basis. So on the sale of the personal residence after May 6, 1997, there's a specific rule where how much you need to pay taxes, or what are the things you need to know to calculate how much is your capital gain to declare on your tax return. So for simpler purpose, we will just use the word gain instead of capital gain. But for you to be used to it, capital gain is just means gain on the capital asset. So to make it shorter, it's capital gain. So when you have a capital gain of 250,000, or if you have a gain of 250,000 when you sold a real estate property that you use for your personal use, or they use for your personal purpose, or like let's say you use it as your primary residence, then that gain of up to 250,000 is excluded. That means it's not taxable. And if you are, however, it's actually good for married filing jointly, because they can exclude up to 500,000 of gain from their income. Note that this 500,000 exclusion on the capital gain, or the 250,000 exclusion for non-married filing jointly income tax filers, you can only use this once in every 2 years. And you have to make sure that if you're married, it applies to both of the spouses. So this means that you can only use this once in every 2 years, like your spouse hasn't used it too for the last 2 years, and you haven't used it yet too for the last 2 years. And this rule of capital gain for real estate property, this includes the mobile homes, houseboats, condominiums, cooperative apartments, duplexes, row houses, and yachts. So if you notice, houseboats is part of the real estate property, even though it's like a machinery and mobile homes. But as long as it's like a personal residence, you can include it to this exclusion. And you have to also make sure that this property, for that it should be your principal residence, and both of the spouses should be using that for at least 2 years of the last 5 years. So what does that mean? 2 years of the last 5 years. So let's say it's time for you to prepare your taxes for this year. You have to count 5 years, which starts on the year that you're preparing the tax return. And within 5 years, look at the timeline that when you and your spouse use that property as a principal residence. And make sure, so the timeline should be from that. 5 years from the date and go backwards. 5 years from the day that you're filing the tax return and go backwards, count back 5 years backwards, and within that 5-year period is the period where you should be using that property for at least 2 years for both you and your spouse. And you have to make sure too that you can only apply for the exclusion of this 250,000 gain if you own the property. So if the property is not even under your name, so that's the key. It has to be under your name. So if it's somebody's name, and even though you're the one paying for it, you cannot claim it because it has to be in the name of you or your spouse to be able to claim it. So any related party transactions where, let's say, your parents are the one paying for it, or your parents are the one who has the name on the property and you're paying for it, or let's say your relatives, you cannot claim it. They are the only ones who can claim it. Whoever's name on the property, they are the ones who can claim this deduction. Why? Because when you file your tax return, there'll be the IRS is linked to the government records, where there is a record, like, and so they were able to match the data that you're declaring on your tax return to the government records. And then also, you also need to know that there is an exception, that if there is a health-related situation or unforeseen circumstances that within the last 5 years, and you cannot use the property as a personal residence to meet for the 2 years, to meet the requirement of the 2-year requirement, there is a formula to still get a portion of the exclusion. And this only applies if your situation is employment related and it's health related and unforeseen circumstances. So example of employment related, your job got relocated and it's obvious, or there is no practical reason to stay at that property when your job is in another state, and so you can use that as a reason why you can no longer meet the 2-year requirement. So that's valid. And then if there's a health related issue, and probably you have to move to another location, so you cannot stay or meet the 2-year requirement. And any unforeseen circumstances, like the natural events or anything that we can think of, let's say earthquake or anything unforeseen that we can prove that that's a valid reason that the house is not even livable to meet the 2-year requirement. And so the exclusion is prorated. So all you have to do is, let's say you have a 250,000 gain, you prorate it by dividing that 250,000 gain by 2 years. And you will also need to use the form 8949 to claim the excluded gain, and use the code H. There's something also you need to know. Starting 2009, any personal sale residence that was sold but rented prior to sale, that property will not get the full 250,000 or 500,000 exclusion. So again, how do you calculate the cost of the personal residence? And that is to go back and recap, that is the adjusted basis, which is like the cost plus the major improvements minus accumulated depreciation. So now, if you purchase another property, then you have to use the same formula, which is the same as original basis plus capital major improvements.